Hey everybody, thank you for tuning in. In this video we'll discuss PubMatic, a company that I've been following since the IPO, and it recently had a major stock price decrease. So maybe you can buy it right now at a great discount. That will be one of the questions I try to answer in this video, and for that we'll use a discounted DCF Valuation. And the other question is if PubMatic is a strong company, and to answer that we'll be scoring PubMatic using my Stockman Investing Scorecard. Next to that, on February 28, PubMatic also released the earnings report for the fourth quarter and the full 2021 results, so we'll also have a look at those numbers. First, let me give you some background information on what PubMatic actually does. PubMatic provides a cloud infrastructure platform that enables real-time advertising transactions for internet content creators and advertisers worldwide. They are committed to delivering the digital advertising supply chain of the future, where both publishers and buyers can maximize value. I'll try to explain later how that works, but for now I'll give you some of the long list of options and solutions that PubMatic provides, just to show you there is more to it than just connecting publishers with advertisers. The company solutions include PubMatic Cloud, OpenWrap, a header bidding solution that provides management and analytic tools, OpenWrap OTT, a header bidding management solution for OTT, which stands for over the top, OpenWrap SDK, which stands for Software Development Kit, which is a header bidding solution for in-app developers. And then they also offer private marketplace solutions, real-time bidding, programmatic technologies, digital advertising, inventory quality solutions, ad quality solutions, and a lot more. Now, I don't think as an investor that you really need to know all of them in detail, but it is good to know all the options and solutions that PubMatic provides. But I do think you need some background information on how programmatic advertising works before investing in companies like PubMatic. So, programmatic advertising is the process of buying and selling advertising space through digital platforms. This eliminates the need for requests for proposals, tenders, quotes, and human negotiation, which were traditionally used before programmatic advertising. Ad exchanges provide marketplaces for digital advertising space through automated actions that bring together buyers and sellers. So the buyers are advertisers interested in purchasing online ad space, and the sellers are website owners or publishers who have digital ad space to sell. Programmatic advertising speeds up the process of buying and selling ad space. It uses software to match buyers and sellers in a fraction of a second as the website or app loads. The buyers, so the advertisers interested in purchasing online ad space, target users based on their behavior, demographic data, cookie data, and other variables across different websites. This enables advertisers to reach specific audiences that are more likely to be interested in the advertisers' goods and services. So this process contains 5 steps. First one is, when a user lands on a publisher's website, their data is sent to a supply-side platform, for instance PubMatic, and publishers use SSP to manage their ad inventory and offer it to the market. Then the SSP sends the impressions on to an ad exchange, which is a digital marketplace that connects platforms and agents looking to buy and sell ad inventory. Then the ad exchange offers the impression to the demand-side platforms, the DSPs. A DSP is a platform that allows advertisers to buy display and ad space with the help of algorithms that target specific users. The DSPs are connected to data management platforms, the DMPs. DMPs help advertisers decide which users to target by matching their user data from the SSP to their own vast databases of user data. The data from a DMP is also known as a third-party data, and brands can merge first and third-party data to strengthen targeting capabilities. And the last step is the ad exchange receives bids from advertisers via the DSPs and awards the impressions to the advertiser with the highest bid. This entire process happens in milliseconds just before a page loads. You could compare it with one large digital market stall, where the advertisers want to buy for the lowest price and the website owner wants to sell for the highest bid. As an SSP, PubMatic stands on the side of the website owner, with the aim of selling their banner space as best as possible. They built their own cloud-based infrastructure that ensures that advertisements can actually buy on that website. The revenue model is that they receive a part of the turnover from the media campaigns that are created via their platform, so an X% of every banner that is sold. The more value the platform delivers, the more customers use the technology. This generates more high-margin revenue, which PubMatic continues to reinvest in innovation and growth. The usage-based pricing model allows the customer to start at a low cost, attracting more customers to get started, while still preserving the ability to monetize the customer over time, because the price is directly tied with the value a customer receives. Now, I can understand that you think, well, this all sounds very interesting, but it's also an easy way to check if it actually works. Well, at the time of the IPO, PubMatic estimated market share was around 2 to 3%, and updated industry data now estimates PubMatic market share to be 3 to 4% as of December 31st. A shift in 1% point over the course of the year is quite significant, given the large and growing total addressable market. And they keep expressing that their goal is to have a market share of more than 20%, so they definitely do not lack any ambition. Let's have a look if the ambition is also transferred to the stock market. PubMatic had their IPO at the end of 2020 and it was priced at $20, but it ended the first day above 25, with even an intraday high of 33.16. So they timed their IPO great to bring it to the market during the whole growth at all price rally. And in a month after, they even surged 350% to a top of around $70. So a nice 3.5x in less than 3 months. In the months after the $70 high, they quite quickly declined, close to the IPO level again. After their Q3 results, they surged again to $40, but in the past several months, they followed the overall market trend and closed on March 11th even below the IPO price of $19.75. Here you can see the price to sales ratio and the total enterprise value to revenue ratio, which are quite close since PubMatic has very limited debt. The multiples are around 8 in January 21 and with a high of 18 at the beginning of March 21. And over the last 12 months, the multiple has slowly decreased to now price to sales ratio of 3.6 for the next 12 months, and the EV multiple is now even close to 3. So based on these multiples, it looks like it's a good moment to buy them. But if you have a look at the total enterprise value EBITDA multiple, this multiple decreased from around 70 to currently not even 8.5, which is actually a great multiple, especially for a growth company. And the market cap free cash flow multiple went from more than 270 to now around 13.5. All of these multiples show that PubMatic was clearly overvalued at some point, but it does seem quite attractive at these levels. And we will see later, with the discounted cash flow valuation, is this also actually the case. On February 28, PubMatic released their Q4 and full 2021 earnings report. So let's have a look at how they performed. Well, it's good to start with the mission. At least that way you can see that they really live by it and that it's part of their culture. First, let's have a look at the total addressable market. You can see that COVID really speeded the trend for the global digital ad spend, with a year-over-year growth in 2021 of 31% and projected year-over-year growth in 2022 of 17%. I do think actually that is quite steep, the 17%, because there are more and more signs that we might go into a recession. But it is clear that the total addressable market is expanding. And if the market is expanding and PubMatic managed to also get a bigger market share, they could be a great investment. This is what I mentioned before, that the estimated PubMatic market share is now around 3 to 4%, and that the long-term market share objective is more than 20%. Good numbers for the supply path optimization. And supply path optimization is really just the process of reducing the number of intermediaries until each is adding value, which increases the value for the buyers and shows that the strategy is working. CTV revenue grew year over year in Q4 with over 6x, which shows that the omnichannel expansion is definitely working. It also grew from a tiny base because PubMatic hasn't focused that long on the connected TV space, but still it's good to see those numbers. The Identity Hub and the Audience Anchor are ways for PubMatic to deal with the increased privacy resolutions and also the IDFA from Apple and now also the increased privacy steps from Google. It's a temporary headwind, even though they showed in recent numbers that they don't really are impacted by it that much. But it also is clearly an opportunity if they can use this Audience Anchor and Identity Hub to provide relevant ads and still comply with the privacy and cookieless environment. They could take market share from competitors. The geographic expansion, good to see that they also focus more on Europe and Asia. In the conference call, they elaborated a little bit on their expansion. So for China, they are focused on the non-Chinese audiences and inventory from Chinese app developers. And based on their experience and success internationally, they believe that international investments will develop into significant long-term growth opportunities, which represents over 140 billion in global media retail ad spend by 2024. So that 140 billion is for both on-site and off-site advertising. Let's start with the financial results. The full year 21 revenue came out in 227 million, which is a 53% year-over-year revenue growth. And in a guidance they released in Q3, they estimated the full year revenue between 225 million and 227 million. So it was on the top of their own estimate. The Q4 revenue came in at 76 million, which is a 34% year-over-year revenue growth, and is also at the top of their own estimate they released in Q3. But both of these estimates have been done in Q3, so you only have to predict for one quarter. If you look back at the predictions they did last year for the full year 2021, they came with estimates of 180 to 185 million, representing a growth of 21 to 24%, which turned out not to be even close. I mean, they completely destroyed their own numbers. So for this year, they again commit a similar growth percentage. So for the full year 2022, they expect revenue between 282 million and 286 million, representing again a 25% year-over-year growth. So let's see. I have the feeling that PubMatic likes to underpromise and overdeliver, as they've done so far for each quarter since the IPO. Increasing profitability, their GAAP net income even reached to 57 million and the net income margin 25%. And for the Q4, the net income margin was even 37%. The adjusted EBITDA was even 96 million, with an adjusted EBITDA margin of 42%. And in Q4, the adjusted EBITDA margin was even 51%. That is what you want to see as an investor, that the margins are improving over the years. Strong diversified advertiser spend. The year-over-year mobile and omnichannel video revenue grew 41%. Year-over-year CTV revenue 6x. Year-over-year desktop revenue growth 26%. The growing revenue visibility and predictability. If you have a look at the net dollar-based retention, that is really impressive. So it basically means that the publishers they have do not only stay with PubMatic, but also they increase their spend over time, which is a great sign. The ad impressions, talking about trillions, always make me laugh because the number is so ridiculously large. 92 trillion ad impressions. And the cost of revenue per 1 million ad impressions is down 50%. So from $1.12 to 57 cents. But if you're talking about trillions and trillions of ad impressions, that decrease really drives the cost down. And the gross profit margins increasing also year over year. Only in Q4 it was a little bit lower than the Q4 20. So it might be that around 80 is the limit, but let's see. At least year over year it's still increasing. The operating expenses, the investing for growth. You can see the OPEX as percentage of revenue is decreasing year over year, which is good. Small increase if you look at the quarter over quarter. And they invest mostly in sales and marketing, which makes sense also when it is opened 4 new offices last year. And then the GAAP and non-GAAP diluted earnings per share. The GAAP net income is increasing a lot over the years to now even $1 per share. And the earnings per share in Q4 were even 50 cents. For the non-GAAP net income was $1.14 in 21. And in Q4 it was also close to 50 cents again. So it's good to see also that the GAAP and the non-GAAP are quite similar. Now the cash flow we have a look at later also with this kind of cash flow valuation. Then the guidance, also important. The Q1 guidance, they give a revenue of 53 on the low side and 55 on the high side. Well, as you mentioned before, it looks like they always underpromise. So let's see if this is again going to be the case this quarter. And the same for the full year, they also estimate around 25%. So hopefully that could be closer to 30%. And the full year capex is in the range between 30 and 33 million, which is in line with last year. So now that we have some background information about PubMatic and had a look at the recent earnings report, it's time to get started with scoring them using my Stockman Investing Scorecard. The first section are the financials. How much debt does PubMatic has? They have a total debt of, let's say, 22.5 million. It's the first year they have any debts. Previous years they always had zero. The ratio, total debt to equity ratio, only from 8.8%. And a current ratio of 1.7. Let's look at the scorecard. You get 8 points for the debt section, 3 points for the current ratio. Then the return on invested capital. Now it's increasing over the years, and last year even a return on capital of 20.6%. So above 15% you get full points, so 12 points for PubMatic, really impressive. The direction of the return on invested capital, as we just saw, is also increasing, 2 points. Then have a look if PubMatic is free cash flow positive. They are almost $1 per share, also 2 points. Then free cash flow percentage of the EBITDA. The EBITDA last year was a total of 47.5 million, and the cash flow is around 55 million. So that makes it the free cash flow percentage of the EBITDA is around 73%. Actually, if you use the exact numbers, it's very close to 75%. So for the scorecard, I'm going to give them 2 points. And the CAPEX percentage of free cash flow, the capital expenditure last year was 30.4 million. So that's a percentage of the free cash flow of around 60. So that gives it 0 points. So with that, PubMatic score for the financial section is 29, which is a very good score. They're missing only 4 points, which is 1 for the free cash flow percentage of the EBITDA, which they most likely will get next time, and CAPEX percentages of the free cash flow. Well, they already mentioned that the CAPEX is going to be around the same levels as last year, also around 30 million. And if their free cash flow is increasing a lot, then they would also at least score 2 points for that next year. So they're going to be close to a full score next time. Anyway, for now 29 points is a more than decent score. Then let's continue with the management culture section. First, the CEO experience. Well, the CEO of PubMatic is Rajiv Goel. He's also the founder, one of the founders of PubMatic, so we're going to get 6 points here. I trust the CEO to act with integrity. Well, so far with all the conference calls and interviews I've seen of him, I think he's completely trustworthy, so definitely no reason to deduct any points here. 0 points. The CEO pay compensation is reasonable and based on long-term success. The base salary of the CEO was 500,000 in 2020. For the Chief Innovation Officer, it was around 250,000, and for the CFO, Stephen Pantelic, it was around 450,000. There's also a lot of bonus included in the salary. So let's say for the entire year, he earned around 3.7 million. And the reason that the salary of one of the other co-founders for the Chief Innovation Officer decreased is because he decided to work part-time. So per hour, he's probably still making a lot more, but he's decided to work less hours. So the compensation itself per year is quite reasonable. But then if you have a look at stock-based compensation, so you can see the outstanding equity awards at 2020, which is a little bit outdated, but the new tax filing hasn't been published yet. I think this one they released in June, so probably in the next several months they released a new one. You can see that the CEO has a lot of option package that will expire starting 2006 to 2030, so at least that's long term. And the same count for Amar and for the CFO also. I mean, the amount for the CEO and the CFO, we're talking about serious numbers. So you can see here the total, if you also include the unexercisable for now, 600,000, 250,000, 350,000. So it's close to 2.5 million on shares. And the current stock price of 20 would make it 50 million only for the CEO in underlying securities. I mean, it's basically if he is going to get 600,000 of new shares every year, with the current stock price, that's 12 million extra he's going to earn per year. And with hopefully an increasing stock price, that's only going to be more beneficial for him. So I think the base salary is quite okay. The yearly annual option award is already, as you earned last year, 3.8 million. But then also an additional 600,000 shares a year, I think that's too much. But since they're at least focused on long-term success, I'm gonna score it in the middle and give it 0 points. Then, skin in the game. As you can see here, they own a lot of shares. The CEO, close to 5 million. Amar, more than 5 million. Erik Kalborg, more than 7 million. In total, they have more than 37.5 million shares. So they have a lot of skin in the game. 6 points. Then, management rating. Recommend to a friend, 82%. Appreciates director, 95%. Overall score of 4.3. And the trend data is not that long, but at least you can see it's increasing. So 7 points. Then the mission statement. We already saw it before, also in the earnings report. The mission is PubMatic fuels the endless potential of internet content creators. Does it provide optionality? Yes, it does. Is it inspirational? Yes, I think it's also inspirational. And is it simple? I think it's also simple to some extent. Could have maybe a little bit more simple, but the mission is basically saying that they want to make sure that internet content creators have ways of making money. So that's quite simple. I'm giving them 3 points. Then insider buying, guru buying. None of the gurus hold stock of Pinterest. And let's see insider selling and buying. There is a long list of sales, at least for the last 6 months. The CFO is selling small amount. The CEO is selling, he's selling 15,000 shares at the beginning of each month. So you can see here at the beginning of March, beginning of February. So he's selling 15,000. I mean, for the insiders, they hold more than 37 million shares. So this is not a problem. Would have been good if one of the gurus would have held shares of PubMatic. But since it's only a 1 billion company, it's also not very likely. It is probably just too small for them. So that gives them 0 points. And a total for the management culture of 22 points. Which is okay. Maybe they can increase their score in the future if their CEO compensation goes down a little bit. And it would also be a strong signal if at these levels that management would decide to buy instead of keep on selling. And maybe in the future it can be picked up also by institutional companies or hedge funds. But for now, 22 points, it's not too bad, could be better. Now for the moat, I'm going to give them 6 points for the AI network effect, because I think that's one of the reasons that they managed to increase their market share. I'll give them full points for the switching cost. For the durable cost advantage, well, PubMatic owns their own infrastructure, so that could be in the future that, we already saw that the cost for 1 million impressions went down from a little bit above $1 to, let's say, 50 cents. So I think having their own infrastructure, it could definitely be a moat in the future. For now, I'm only going to give them 3 points. For the intangibles, maybe for the trade secrets, but I think I already gave those points combined in the network effect and the durable cost advantage, so I'm going to give them 0 here. And then for counter position, I'm going to give them 2 points for their counter position against Meta, Google, etc. And for current research, 0 points. Which gives a total of 21 points for the moat. That's a nice strong moat. Maybe in the future that the durable cost advantage could be a lot higher, maybe even full points. But I think for now, 21 points, it's a fair score for them. Then let's have a look at the potential, the optionality. Give them 4 points. I think there's quite a lot of potential if they want to make sure that content creators have ways to make money. So there's a lot of directions to go, but also not unlimited. Right, they're already going connected TV, and at some point they are on other channels that also the content creators are on. But still, there's definitely enough optionality. For the risk, so let's start with industry disruption. No, 0 points. Binary event, also 0 points. Now for the customer concentration, they always mentioned that Verizon was a big part of their revenue. So I think a year and a half ago, there was definitely more than 25%. A year ago, it was still 20%. In the latest update, it was only 17%, so it's going down, but I'm going to deduct a little bit of points for that. So I'm going to give them -4, which brings the total amount of points to 72 and the final score to 76. So that's within my investing range. Above 75, I'm willing to invest in, so that's a good score. That answers the first question, if PubMatic is a strong company. Well, according to my framework, and according to me, it is definitely a strong company. So now let's have a look if you can also buy them at a good valuation. I already filled out the data, but let's talk through the assumptions. So the revenue from PubMatic was growing with an average of 32%. Last year they had a revenue as 227, as we discussed. And as I mentioned in the earnings call, the outlook for 2020 is around 25%. Now again, I think this is quite conservative. But let's see if the total addressable market maybe it's not growing as fast as projected due to possible recession. So I'm going to stick with 25%, but most likely it will be a little bit higher than this. So it starts with 25% and goes all the way down to 13%, which gives the revenue of a little bit over 1.2 billion in 2031. The gross profit margin is increasing slowly from 68 in 2018 to now close to 74.5 in 2021, with an average of 71%. I have the gross profit margin increase from 74.5 to 76.75. This gives a gross profit from almost 940 million in 2031. As we saw in the earnings report that they already had a gross profit margin of close to 80% in Q4. So it could be that the gross profit is a little bit higher than this, but just to be conservative, I'm going to have it slowly increase. The selling and marketing expense is decreasing as a percentage of the revenue, so from almost 51% in 2018 to close to 41% in 2021. And that trend is continuing, so we should have around a cost of 115 this year and all the way to 435 million in 2031. Same for the research and development. They actually spent very little on research and development, from 30 million in 2018 to only 60 million in 2021. So in the 4 years, there's not a lot of increase. So that also means that the trend as a percentage of the revenue is decreasing. I do hope that they're going to spend a little bit more in the future, because 12-16 million, it's nothing. Especially when you expect that at some point they will reach 1 billion in revenue. They can spend a little bit more on development than 15 million. The EBITDA has an increasing EBITDA margin of an average of 15, and it's increasing from 27 to more than 35. So that's a nice increase in EBITDA margin. The free cash flow, they were free cash flow positive last year, 55 million, and the free cash flow is going to be around 73 million this year, and will go all the way to over 400 million in 2031. The shares outstanding increased a lot last year due to the IPO. And after the IPO, they stayed quite stable for now at least 4 quarters, but I'm still going to have them increase their share amount with 4% per year. So it's going to be close to 84 million in 2031. I don't think they need that much extra shares because they're cash flow positive and they have cash, so they don't really need that much extra shares. So the only shares that it's gonna be extra is for share-based compensation. And that way we're talking about a couple million per year. So that's why I have to increase it with 4%. The cash increased from 21 in 2018 to 82 million in 2021. And if the trend continuing with 10% per year, we gives it an amount of around 250 million in 2031. They didn't have any debt until last year. Last year they had a debt of 23 million and had the debt increasing with 10% per year, which only gives it the debt of 60 million in 2031. Then here the return on invested equity, nice trend up, even more than 26%. Return on invested capital, more than 20%, also a nice trend. Then here you can see the market cap, enterprise value, share price. It gives it a multiple in 2020 of 14.5. Last year it had a multiple of 31.5. And if you continue with the same share price, so I have it here at 19, it gives it the enterprise value EBITDA multiple of 13.5 for this year and even below 11 for next year, which is, well, in my opinion, way too low. So with these assumptions, we're going to have an enterprise value in 2031 of 7.7 billion, 59 million debt, 214 million in cash, gives us the market cap of almost 8 billion, with a share price of $95. And if we use a discount rate of 12% and a margin of safety of 25%, which is again my standard margin of safety because we're doing a lot of assumptions, it gives that with the current price of around $19, PubMatic is undervalued almost 55%. And if we look at the 5-year discounted cash flow valuation with the same assumptions, only in this case we use a total value multiple of 20, because only 5 years. For the 10-year I use 18, which gives us a valuation right now of almost 26, which is still more than 38% undervalued. So for the people who follow me on Twitter, I already announced 2 weeks ago that I made my first purchase. I think it was around 22. And I'm definitely going to continue buying. Because for me, they're clearly a strong company and they're definitely undervalued. And if you think about the share price of 95 in 2010, which is a nice 5x from here, to me, a definite buy. That brings us to the end of this video. I really hope you enjoyed it. And if you did, please press the like button. And if you want to see more videos for the stock market, please subscribe. Thank you for watching and bye for now.